Hi everybody, it's Jacques Fischer, founder of Transpose, the leading trust and tax company in South Africa, where we teach entrepreneurs, property investors, business owners and wealth creators how to create, protect and grow their wealth so that they can become financially free and be in a position to leave a legacy for their family and their loved ones. In this video, I'm going to teach you how you can literally play the game of business and property investment with a new set of rules, where you can create and protect your wealth in separate compartments or trust structures that during your lifetime and on your death will save your family hundreds of thousands, even millions in taxes. Our main objective at Trust Focus is for you to own nothing. No assets, no money, no property, literally nothing, but to control everything, all your assets and all your wealth, just like the rich and the wealthy have been doing for centuries already. If you own nothing, you've got nothing to lose. We want you to become a bulletproof entrepreneur, a bulletproof property investor, a bulletproof business owner and wealth creator. We also want you to become unsequestratable. Think of it as being legally untouchable. If you don't own any assets, you're not worth a cent to a liquidator anyway. This means they can't even sequestrate or liquidate you. The goal of the game is for you to own zero in your personal capacity, to leave your estate with absolutely zero when you pass away. We will show you how you can literally and legally, effectively separate your assets from your liabilities so that you can substantially mitigate and also minimize all your risks, or at least some of your risks. Here are 5 everyday risks that entrepreneurs, property investors, business owners and wealth creators come face to face with daily during their business operations. Number 1, your spouse could potentially become your biggest creditor. 50% of South African marriages end up in divorce, unfortunately. Number 2, business creditors suing you for loans or any accounts that might be outstanding. Risk number 3, SARS is a massive financial risk for the entrepreneur, the property investor, the business owner and the wealth creator, especially in the form of estate duty, capital gains tax and executors fees. If your assets, your blood, sweat and tears are not structured correctly in wealth protection and wealth creation trust structures, SARS will wipe out close to 35% of your net wealth through taxes on death. The 4th risk that entrepreneurs and property investors face is business failure. If all your assets are still in your own name, the first wave of creditors will take judgment as fast as they possibly can. They will attach your assets, they will auction it off as quickly as possible, and you'll be realizing around about 20% of the true market value of your assets. On the other hand, if your assets are structured in a trust and the trust is the legal and legitimate owner of your assets, you will be worthless. You will be worthless to any creditor. Risk number 5, claims by your employees. Your employees can sue you for unfair labor practice. Your tenant can sue you for slipping in the property while he's showering. Weird things do indeed happen, and we need to be prepared for anything. The rich and the wealthy business owners and the wealthiest people of our time don't own a car, they don't own a business, and they don't own any assets or even money. They do coincidentally control their businesses, their properties, and also control all their assets through setting up the correct trust structures. Each trust structure should contain its own underlying and individual risk. The most successful entrepreneurs, business owners, and property investors that I have been very fortunate to personally meet in our live seminars and through personal consultations and strategic meetings, have all structured their life and their assets in separate trusts containing and housing their different asset classes of investments. For instance, they will have a family trust for their paid off no debt assets. We refer to this as your unencumbered assets. They also have a separate trust containing their bonded properties they use for wealth creation. They also have a third trust called a business shareholding trust that contains the shareholding of the respective company or companies. And the more companies they have, the more trusts they set up that will house that specific shareholding of that specific Pty Limited or business. Now, I would like to share with you the 5 absolute myths, the misconceptions, the biggest misconceptions in the financial industry today surrounding trusts. I'm also going to teach you the 10 indispensable reasons why every entrepreneur, property investor, business owner, and wealth creator must have their trust created before buying property or before going into a new business venture. Let's start with what I call the 5 absolute myths and misconceptions about trusts. When I'm talking about a trust, I'm specifically referring to an inter vivos discretionary trust. It is a living trust, a trust that is set up while you are alive, not a testamentary trust set up when you die. The first myth and misconception about trust is, and I always hear my investors and my students say, trusts are only for the wealthy, Jacques. And I always say, well, the truth is, the wealthy have set up these incredible wealth structures and trust structures, these vehicles, before they became wealthy. Trusts are for the ambitious. Trusts are for the hard-working, the visionaries, the entrepreneurs, the property investors, the people that believe in their own ability to create and protect wealth the right and the legal way, so that they can enjoy the same tax advantages and asset protection advantages and benefits that the wealthy have been enjoying for centuries already and are enjoying today. You know, the irony of all of this is that a correctly structured property investment trust or business trust or family trust is the exact vehicle that has been used for over 900 years to create wealth and leave legacies with. Yes, folks, this thing called a trust is more than 900 years old, and it's probably going to be here for another 900 years. The vehicle you choose to create and protect your wealth in is indispensable for you achieving your financial freedom goals. Just remember that you can be the best racing driver, but if you're driving an old pickup truck and your mother climbs into a new Ferrari, she's going to make you look silly. She's going to beat the pants off you again and again, and she's going to win the race. You don't want your mom to beat you, do you? Well, I thought so. And myth number 2, trusts have the worst tax rate, I hear people say. Well, this is true, but only half the truth. It's only where the trustees decide to retain the profits and not distribute such profits to the beneficiaries, where the trust will be taxed at the 40% marginal tax rate. Trust law and the Income Tax Act allows a trust in terms of a concept called the conduit pipeline principle, where you can shift the tax burden from a trust to the hands of the beneficiaries, such as an individual, and therefore paying tax at the individual's marginal tax rate. You can legally make use of this incredible mechanism and achieve better tax efficiency than you ever could have in your personal capacity. Myth number 3, trusts are expensive, I hear everybody say. Yes, it's true. It does cost money to set up a proper trust structure. The question you should rather be asking is, how much money is it going to cost me and my family by not having a proper trust created? In practice, a correctly structured and administered trust is a lot more economical and also more cost efficient than running a CC or even a Pty Limited, a company. What really is the most expensive is the cost of ignorance, the cost of not being properly informed and educated with regards to the real benefits and the real advantages of a proper wealth creation trust and wealth protection trust. The cost of estate duty, capital gains tax, executors' fees, and income taxes not taken advantage of because you never took the time to set up a proper trust structure is very, very, very expensive. The bad news is you are going to die, and taxes will have to be paid, and debts will have to be settled, but not in a trust, as you will see shortly. Another cost saving is that most trusts, if specified in the trustee, does not require to be audited annually, which will save you a lot of money, especially from an administration cost perspective. Of course, all trusts must be registered for income tax purposes at SARS. Myth number 4. I will lose control over my assets. I always hear people say, especially if it's owned by a trust. There is a big difference how this notion of giving up control over your assets is executed in practice versus how it is theoretically taught and interpreted in our academic society. It is very important to note that there should always be a minimum of 2 trustees, one of those being totally independent from the founder and the beneficiaries. There must be a clear distinction between control and enjoyment of the trust assets, and the unbiased, unrelated, and impartial third party called the independent trustee is the perfect person or juristic entity to satisfy the South African Revenue Service that there is indeed a clear distinction between control and enjoyment of the trust assets. In practice, the trustees are the parties that control the trust. That's why careful consideration should be taken whether a spouse needs to be part of the board of trustees. There are ways of structuring your trust so that you don't feel that you are giving away full control over your assets. And there are also ways of structuring your trust where you will be the founder, the trustee, and the beneficiary of the trust, with other beneficiaries and trustees, and still satisfy SARS and the Master of the High Court of the legitimacy and the lawfulness of your trust structure. The concept of a trust have worked successfully for over 900 years, and I'm almost dead certain that it can and will successfully work for you and your family. Myth number 5. Trusts are being investigated by the South African Revenue Service. Most of our parliamentarians, politicians, and friends from government have trust structures in place, and it would be very surprising to see them changing trust laws so that they can lose millions of rands in their wealth portfolios that are perfectly structured and positioned within multiple trust structures. SARS have been investigating trusts for many, many years, but so is every other entity like a company and CCs and even private individuals being investigated every single year for multiple years. Trusts are also being investigated when they have been brutally misused and mismanaged. If a trust is structured correctly and administered properly according to the Trust Deed and the Trust Property Control Act that governs trust in South Africa, you will have peace of mind knowing that your trust will be 100% bulletproof. Here are the 10 indispensable reasons why you should be setting up your trust structure as soon as possible. The type of trust that we are referring to and that we're talking about is an inter vivos discretionary trust. This is a trust that is set up while you're alive. The first reason why a trust is indispensable and why you must seriously consider creating a trust is number one, the primary reason asset protection. Without any doubt, the best and most holistic asset protection strategy for entrepreneurs is to have a minimum of 2 trust structures consisting out of the following. Number 1, a wealth protection trust, also referred to as your family trust. And number 2, your wealth creation trust, referred to as your property trust. In the wealth protection trust, the first trust, you want to effectively separate your assets from your liabilities and have them in 2 separate different compartments. Your paid up assets should be housed in the wealth protection trust. Like I said, this is referred to as your family trust. Also, your no risk trust. Your wealth protection trust will hold your debt-free and risk-free assets like paid up cars, furniture, household contents, typically your movable assets, your investments, listed shares, and even your life insurance, your cash, and your equipment. By the way, there are some serious and massive tax advantages and asset protection advantages if you've got your life insurance policy structured the right way. The second trust is your wealth creation trust, the property trust. This is also referred to as your business share trust. This can be in the form of a property or business share trust, where your business shareholding is protected in the business share trust. Remember that having all your assets in the same trust can potentially cause the proverbial domino effect. Remember, one single asset being at risk can expose all the other assets contained in that particular entity. This is the core reason you don't ever want to mix your indebted assets with your paid up assets in the same entity. For example, bonded properties should not be mixed with paid up assets like your paid up vehicles, furniture, equipment, or cash, all in the same entity. By the way, an inter vivos trust, discretionary trust, is the perfect entity to structure your buy-to-let property investment properties in. The second reason why a trust is just indispensable is for the following reason. There is no estate duty payable on your death. One of the biggest tax bills, besides your personal income tax bill that you will incur, occurs on your death. As much as 1/3 of all your life's assets, your blood, sweat, and tears, will go to SARS. These are assets that you have acquired with money that you've already paid tax on while you were alive. The most important thing that you have to remember is that a trust lives in perpetuity, forever, and a trust never dies. It literally lives forever. By having a trust created, the saving of 20% in the form of death taxes above the 3.5 million rand abatement amount, effectively, it is a estate duty that you're saving, and estate duty is a tax on after-tax money. This is what I call double taxation, and is just insane, especially if you can so easily avoid it by merely putting a trust structure in place. The third indispensable reason why you should have a trust is there is no capital gains tax payable on death. Capital gains tax is levied on the event of the disposal of an asset. The death of an individual is also deemed such an event. On your death, it is seen as you have disposed of your assets to your deceased estate, and this triggers the tax on all assets that appreciated in value. By having your properties and all your assets in a trust, there will be no capital gains tax of 13.32% payable on death. This means zero capital gains tax on your death. The fourth reason why a trust is indispensable is because on your death, there is no executors fees payable. No executors fees of 3.5% plus VAT. And please note that the executor who is appointed to wind up your estate will charge around about 3.5% of the gross value of your estate, which means this could effectively end up being hundreds of thousands of rands. If all your assets is in a trust, you will have no estate to wind up, and therefore executors' fees will again not be applicable. The fifth reason why a trust is indispensable is that there will be no costs on death payable. Many costs will arise on your death, like costs to cancel bonds, costs to transfer any properties, as the estate cannot be winded up if there is debt in the estate. If your properties are held in a trust, the debt will not have to be settled, and there will be no cancellation of bond costs, as well as any transfer costs, as the beneficiaries can become the follow-up trustees to manage and administer the trust assets. No tax implications. The sixth reason why a trust is indispensable is that it gives you incredible income tax benefits and advantages. Please remember that the primary reason why we create trusts is for asset protection. However, there is a very important concept firmly entrenched in the Income Tax Act called the conduit principle. The trustees of the trust, the board of trustees, can choose to let the trust pay income tax on its own income, or they can choose for the individual beneficiaries to pay income tax in their personal marginal tax rates if the trustees decide to distribute the trust income down to the beneficiaries. If your children are beneficiaries and not paying tax, it would make sense for them to pay the income tax rather than have the trust pay it, wouldn't it? The first 70,700 Rand income received for an individual earning income in South Africa is tax-free. So if you have children that are minors, it will be a good idea to declare the tax liability of the trust income in their personal hands instead of the trust. This means the tax liability of the trust can be drastically minimized and cash flow can be optimized. You can do the same with rental income and interest earned from the trust. This is absolutely awesome. The seventh reason why a trust is indispensable is that the minors of the trust, your children, will be protected. The South African law does not allow for minors to inherit. This is because they do not have any contractual capacity. If you want to bequeath or leave your assets to your minors, children under the age of 18, the assets will have to be liquidated and paid to the Guardians Fund, which is like a money market fund administered by government. You definitely don't want the government looking after your children's money until they reach the age of majority, which is 18 years old. Take care of your children and show them love by creating a family trust to protect your wealth, not just today or on your death, but also for future generations to come. The eighth reason why a trust is indispensable is that there is no estate freezing, and your loved ones, like your spouse, will have access to your accounts, your assets, and your cash immediately on your death. The ninth reason why a trust is indispensable is because it is the perfect buy-to-let property investment vehicle. Unlimited losses can be accumulated in the trust, and refinancing is tax-free. That can be used to accumulate more losses and more assets, and you just purchase more properties with tax-free money. If you understand the bigger picture about this scenario and you know how to practically implement it, it will be a total game changer for you and your property portfolio. We explain property investment, refinancing, and building a proper sustainable portfolio in the iGrow Property Investment Seminar. So please attend one of our property investment seminars as well. The 10th reason why a trust is indispensable is because you can leave a legacy. If your trust is properly structured and drafted, there will be comprehensive continuity and succession planning for generations to come, and your assets will transfer tax-free from the one generation to the other. I really hope that what I've shared with you have shed some light on the myths and the advantages and the incredible opportunities that lies awake and waiting for entrepreneurs to take action on. Wealth protection and wealth creation is both critically important in today's society and volatile economy. With more than 90% of business owners who close their doors after 5 to 7 years after opening them, is unfortunately a reality and a frightening statistic. If you're serious about creating and protecting and growing your wealth, and very importantly, leaving a legacy, don't wait another minute. It's your responsibility to create and protect and grow wealth for yourself, your family, and your loved ones, while you leave a legacy for generations to come. Do it now. Do it today. And give yourself the peace of mind that your family deserves. Successful investing.